What caused the XIV ETF to fail? Have you ever wondered why some investment products can suddenly collapse, leaving investors in shock? Today, we are going to look into the failure of the XIV Exchange-Traded Note, or ETN, and what led to its dramatic downfall. The XIV was designed to provide the inverse performance of the S&P 500 VIX short-term futures index. This means it profited when market volatility, as measured by the Volatility Index, decreased. Essentially, it was a bet against volatility, using derivatives to achieve this inverse exposure. Before its failure, the market enjoyed a long period of low volatility. This environment attracted many investors to the XIV as it consistently generated positive returns. However, this calm period led to heavy selling pressure on Volatility Index futures, pushing their prices below historical norms. Investors were confident, but this was a setup for disaster. In early February 2018, everything changed. A sudden equity market sell-off caused the Volatility Index to spike dramatically. This spike was much higher than what the XIV and similar products were prepared to handle. Because the XIV was short volatility, this sudden increase caused a rapid drop in its value. The mechanics of the XIV's failure are quite interesting. When volatility spiked, the XIV had to rebalance by buying Volatility Index futures to maintain its inverse exposure. However, since XIV held a large market share of these futures, its forced buying pushed prices even higher. This created a negative feedback loop. As volatility rose, the losses for the XIV accelerated, requiring even more buying of Volatility Index futures, which worsened the situation. Additionally, the XIV had an acceleration clause that triggered automatic liquidation if losses exceeded a certain threshold. When the volatility spike caused losses to surpass this limit, the issuer had no choice but to liquidate the ETN. This liquidation happened very quickly, wiping out about 90% of investor value in a single day. The concentration of short volatility exposure in products like the XIV amplified the market impact of the volatility spike. The liquidity of Volatility Index futures was not enough to absorb the large forced trades without significant price disruption. This made the situation even worse. From this event, there are important lessons for stock trading and options. Short volatility strategies, especially those using inverse exposure, carry significant risks during volatility spikes. Leveraged volatility exchange-traded funds and exchange-traded notes can experience rapid and severe losses due to their rebalancing mechanics and market liquidity issues. Understanding the underlying derivatives and their market impact is essential before trading or investing in such products. Risk management should always consider the possibility of sudden volatility shocks and the potential for forced liquidations. In essence, the XIV ETF failed because it was a short volatility product that became overexposed during a sudden volatility spike. Its own trading mechanics, combined with market concentration and liquidity issues, led to rapid losses and forced liquidation. This event serves as a reminder of the risks associated with trading inverse volatility products and the importance of volatility analysis in options and stock trading strategies.